Good afternoon, folks. Welcome back. All right, so we're looking at the dollar index. This is how we left the charts the last time. And we had a breaker we were working off of here. Liquidity pool, obviously, we'd be resting below there. Market trades through it. Small little inefficiency right in here. So we'll watch to see if there's any sensitivity once we trade back up into this price action here. Now, I think that we'll probably trade sideways on the cable and dollar relationship. In other words, there shouldn't be too much more of a trending move. At least I wouldn't expect it this week. Obviously, it can continuously power higher on cable, but it's not necessary at this point. Everybody and their brother wants to buy British pound now. So if we look at price here, we have very little in terms of inefficiency over here to concern ourselves with. So we're just watching to see what this price action right in here, these lows, will they offer some resistance here after clearing up this little tiny inefficiency right there. Now, if we trade back through it, it would need to go back above this high for me to consider anything on a bullish stance for the dollar. But until then, we're narrow sideways to lower. We mentioned on Eurodollar that there is a difference or contrast between an inefficient move like this, where it's all one single or several single elongated candles, versus the back and forth, up and down, really efficient delivery of price. Very little sell side was offered here. Both sell side and buy side were offered inside of this area. As a result of this type of price action, I was teaching that this run above this high in here up into this old breaker would be met with a great deal of resistance. In other words, it would be hard for it to get up through there. And you can see it spent a lot of time getting up into it and then popped through a little bit. We've consolidated in here. It didn't even really get back up to the breaker yet. It may never even do it the remainder of this month of February, but it's totally ugly. Okay, in other words, this price action is very sloppy. I don't like to trade in these environments because it's stuck, basically. There's no other clearer term to describe it versus a market that has a lot to move fluidly from one point of liquidity to the next, versus where it's like this, where it's back and forth, it's stuck. There's no other way for me to say it. We just want to be very careful expecting upside breakouts on Eurodollar. Now, can it do it? Yes. But I don't like to trade in that because these are high resistance liquidity runs. So contrast that with that of the low resistance liquidity runs seen in the British pound as we outlined. We had a consolidation in here. This run down hit our 29.68 level beautifully. And I'll show you some more detail about this on Friday. British pound trading very aggressive Monday, Tuesday, and Wednesday. I think that if we do make a higher high, it'll probably be more shallow of a run above it and just hang around the highs, if not retrace a little bit. I don't see anything down here except for this low that may be of interest. So it could trade sideways and drop down in here and then maybe make a slightly higher high on the week. But I think we've pretty much put the lion's portion of the move in for the week. Is it the weekly high? I'm not going to say that because I would be betting against the underlying institutional order flow, which, again, I mentioned this over the last couple months. Be careful with this one. I think they're going to send it up higher. And here we are. If we were to look at a bare bones cable chart, you can see these equal highs that we looked at for months finally have been blown out. So if we look at the high being 32.97, we're just going to basically call it 33 big figure. So 33 big figure, if we were to go and use a 10, 20, and 30 pip price swing above that for stop run, that would essentially give us around that 33.30 level. right there. And once we go past these equal highs, to the left we have this short-term high here. So it comes with a high 33.61.5. So between 20 pips above this high here and the mid figure, 30 is good. So we could do 33.50, maybe a spike through to 33.65 if it were to get animated for the rest of the week. Again, that's not important to see that now. Here is the overall price structure on a daily chart. Rather dynamic. As I mentioned, we probably see some large ranges to run up in there and get those weekly equal highs and or the daily chart equal highs shown over here. So institutional order flow has been bullish on cable. Fighting it would have been reckless and dangerous, but buying into it, you had to be very, very nimble. Power 3 evident every single day, and we had a nice little consolidation right before the run up, clearing this liquidity pool as well. If we drop into a 15-minute time frame, okay, you can see relative equal lows in here. That may be a liquidity pool. It may want to reach down into that, but again, I think we'll probably just, obviously you don't want to fight this and go short. That's what I'm saying. You don't want to sell British pound, but if it does drop without making a higher high, it'll just come down probably to take some liquidity and then shoot one more time, and then that will really get everybody excited, wanting to be a buyer of British pound, and then it'll probably make the weekly high and then trade off into the close for Friday. Where will that close be? It's not important again. All we do is look for the highest probability setups in the direction of institutional order flow. I shared with you guys on Twitter today a setup for the S&P 500. Now, this is actually the market that I learned how to trade effectively on, this and the bond market, when I was a commodity trader, futures trader. And you can see that the elements that I teach in the mentorship are still here, just like anything else. Now, I don't have all the other bells and whistles that will be used for S&P, which brings me to my point. I want to ask you all, on your AVA demo, if you pull up new chart and you go to the bonds area, is your 5, 10, and 30 year missing too? Because it's not on mine anymore and I can't pull it up. So if this is what you're encountering, let me know. If you still have yours, I'll probably have to download this again. I don't know why it would be necessary, but it's missing. So I can't pull up the bond information to justify this. You can see the run below these lows here. High energy run down. Take the stops, leaving an equal high in relative terms. And then we have relative highs up here that are equal. So as it is right now, you've watched me take, and I'll show you everything still happening from the same account. This is that cable trade. And then here is the half of the position I took on. I bought 8 contracts of the S&P when we were trading here on the order block. So inside this down close candle and below this low key, that's optimal trade entry. Not optimal trade entry, the pattern with fib. It's optimal trade entry because it's optimal. It's below, and I'm buying the sell stops. No real drawdown to speak of. I mean, it's like maybe, what, 1 point? Not even that, probably. So the idea was to see a run above these equal highs, take something off, and you saw that in the chart. I was annotating it saying that I would take 50% off, so 4 of them came off. Here, I'm going to take 1 of the remaining 4 off, and I'm going to try to hold for a run up into the liquidity pool right here. Let me zoom over here. The equal highs here, I have the remaining balance up here. So I'm going to try to take 3 off up there, 1 off at the next equal high. So you can see that's happening here. I'm going to leave the stop as it is here. Why am I raising the stop to this point? If you look at this candle right here, okay, we have the low the lower low, the high in between, find the up close candle. That's this one right here. Now, if I take that and I measure it in the scope of a fib, just to get, all we're doing is getting the Fibonacci measurement for 50% of the range. It's not Fibonacci's doing anything magical. It just helps me specifically nail down where my stop would need to be relative to the equilibrium of a specific range, or in this case, below the mean threshold. So this 50% level right here, in my mind, while I was doing the trade, I visually watched it and said, well, I don't want to have a stop loss at this price point or close to it, because I could get stopped out prematurely. So I want to use this level to have my stop loss below it. So it's going to take a real move to get down there and stop me out. That's why I'm not concerned about worrying about stopping out or moving my stop, all that, because this is now a breaker. So I'm allowing for what we saw here, this run up, come back down into it. Hopefully we can see some expansion, run up in here and get the buy side liquidity resting above here. My stop loss will stay at this spot because I don't want to chase up inside of the range, because I don't know where the retracement is going to come. And that's the benefit of taking scaling profit position exits, because if you do that, you're funding your position, you're appeasing the trader, and you're also following the analyst inside of you. So it doesn't force me to obsess about whether or not I'm going to get stopped out. I'm not worried about the stop loss because it's outside of the scope of what would be reasonable in terms of normal static price action. And what I mean by static price action, the normal ebb and flow of up and down price movement. I'm not eager to put my stop loss inside of the range above the breaker, because I don't know where that retracement would come. It could come up a little bit, fall short of this, come down, knock me out right before running the equal highs. I'm not concerned about that here because my stop is below the mean threshold of the breaker. Okay, so I'm allowing market structure to support my trade idea. I've already funded myself. Even if I got stopped out, even on the stop out here, it gives me about 3,000, I think it is, or 2,500 rather. So 2,500 if I get stopped out, and I've already took, what was it again? 5,700. And again, it's demo. It's not important. It's about money, but we're just teaching trade management. And this is the same thing you would do if you were in a Forex trade, demonstrating that. The way you would manage it, you just want to keep your stop loss below the key turning point, which would be a breaker here. I do not want to have a stop loss above the mean threshold of that breaker, because it could very easily come back down and touch the breaker one more time and knock me out and then run away from me. So I wanted to share that with you today. I'm going to give you one more video lesson tomorrow.